I just transferred $100,000 of my own money into Robinhood. My goal is simple. Turn it into $1 million. No paper trading, no backtests, no hiding losses. Every trade, every decision, every gain, and every mistake will be public on this channel. In the end, I'll either hit 7 figures or lose $100,000 trying.
So why is this channel different? Look around YouTube. There are thousands of people telling you what they bought after it already went up. It's easy to look like a genius when you're explaining the past. Our channel is different. This isn't a masterclass. It's a real-time documentary. You'll see my research,
my analysis, my entries, and my mistakes before the market decides whether they're right or wrong. When a trade works, you'll watch the portfolio grow. When I'm wrong, you'll see the exact dollar amount disappear from the account. No cherry-picked screenshots, no deleting bad trades, no pretending losses didn't happen. One more thing. You won't see my face on this channel. Not because I'm hiding the results. You'll see every trade, every position, every gain, and every loss. The one thing I'm choosing to keep private is my personal identity. When you're publicly sharing a 6-figure account, and hopefully one day a 7-figure account, privacy becomes part of risk management.
This channel isn't about me. It's about the decisions, the analysis, the discipline, and the process. Credibility comes from data. Suspense comes from decisions. And every decision starts here. This is the starting line. Okay, let's get started. Right now, the portfolio is worth about $100,000. Getting to $1 million won't be easy. To make this work, I need to do 2 things at the same time: protect my capital and grow it as much as possible. So I'm splitting the portfolio into 2 parts. 80% will be dedicated to investing. The other 20% will be used for trading. The investment side is simple. I'll be buying and holding stocks that I believe can create long-term value. The goal isn't to predict what happens next week. It's to own great businesses and let time do the heavy lifting. If my thesis hasn't changed, I'll keep holding. The trading side is where I'll be using options. Options can generate much bigger returns, but they also come with much higher risk. Every trade will have a plan, a reason for entering, and a reason for exiting. Some trades will work, some won't, but every one of them will be documented. Every week, I'll share exactly what happened in the portfolio. Every stock I bought, every option I traded, every position I closed, and exactly how much money I made or lost. I'll also share a weekly portfolio report so you can track the performance with me. Everything will be transparent. Let's see where this journey takes us. Okay, now let's talk about the execution frameworks behind this portfolio. One of the biggest mistakes investors make is letting emotions drive their decisions. Fear, greed, FOMO, panic selling. I've made those mistakes before. That's why every decision in this portfolio follows a set of rules, not emotions. Let's start with the investment side. Before I buy any stock, it has to answer three questions. First, is it a great business? Second, is it trading at a price that makes sense? And third, what's my exit strategy? If I can't answer all three, I don't invest. It's that simple. I'll explain exactly how I answer those questions in future videos.
Now, let's move to the trading side. Before I place an options trade, I go through 3 steps. First, I analyze the overall market. I don't want to trade against the trend. Second, I identify the best entry. And finally, I define my risk before I enter the trade. That means knowing exactly where I'll take profits and exactly where I'll cut my losses.
Once the trade is open, the plan doesn't change. No chasing, no revenge trading, no emotional decisions, just following the process. I'll break down both frameworks in detail in future videos. But these rules are non-negotiable. They're the foundation of this entire journey.
Okay, now let's look at the trades I opened last week. You'll notice that all 3 positions are cash-secured put options. Why? Because these are stocks I'd be happy to own at the right price. If I collect the premium and the options expire worthless, that's a win. If I'm assigned the shares at my strike price, I'm happy to own them for the long term. The first trade is on Palantir, ticker symbol PLTR. I sold a put with a $115 strike price, expiring on July 17th. That brought in a premium of $380. The second trade is on Celsius Holdings, ticket symbol CELH. I sold a put with a $28 strike price, also expiring on July 17th. That generated $140 in premium. And the third trade is on SoFi, ticket symbol SOFI. I sold 2 put contracts with a $16 strike price, expiring on August 7th. Together, those contracts generated $180 in premium. Right now, all 3 positions are still open. 2 of them are currently profitable, and 1 is showing an unrealized loss. But that's only part of the story. Over the next few weeks, I'll show you exactly how these trades develop, whether I close them early, let them expire, or get assigned the shares. Every decision and every outcome will be documented right here on this channel. Before we continue, I'd like to make one thing clear. Everything you see on this channel is for educational and entertainment purposes only. I'm not a financial advisor. Nothing in these videos should be considered financial advice. Always do your own research and make your own investment decisions. Now, let's take a look at what happened in the market last week. One thing really stood out to me. Micron reported strong earnings, yet many of the AI-related stocks sold off shortly afterward. Let's take a look at the SOX chart, also known as the Philadelphia Semiconductor Index. As you can see, last week's candlestick formed a bearish engulfing pattern, which is often considered a potential sign of a short-term trend reversal. To me, the market may be sending a message. After an incredible rally in AI and semiconductor stocks, investors appear to be locking in profits. At the same time, capital may be starting to rotate into other sectors. One sector that's really caught my attention is software. Let's take a look at IGV, the software sector ETF. As you can see, IGV recently attempted to break higher, but got rejected right at the 50-day simple moving average, the blue line on the chart. From there, price pulled back and moved down into this area, where a reversal candle has already formed. And importantly, this zone also lines up with a key support level, the 61.8% Fibonacci retracement. What's also interesting here is the volume. We're seeing a pickup in volume on this bounce, which suggests there may be some institutional buying stepping in at this level. So heading into next week, I'll be watching IGV and the broader software sector very closely. If we get confirmation of a bounce here, this could present some solid trading and investing opportunities.
I'll keep you updated here on the channel. And if you want to follow what I'm trading or investing next week, or if you enjoy these types of market breakdowns, make sure to like and subscribe. I'll continue sharing my process, my trades, and most importantly, my journey from 100K to 1 million. Thanks for watching.